Mark, and I am your host, Mark Hairston, and we're going to talk about mortgages today. Specifically about a product that's designed just for seniors. If you've been listening to this channel at all, or my show, I should say, not the channel, for the last several weeks, I'm talking a lot about reverse mortgages. The technical name is called a HECM. It's called a home equity conversion mortgage, and these loans, at least the ones I'm going to be talking about today, are insured by the federal government, by FHA. Okay. There's a lot of reasons for that, a lot of benefits of that, I should say, that we may touch on. But for the last couple of years, a side note is I posted on Facebook this week that I just applied for my Social Security benefits starting August 1. I'm very excited about that. I've been working since I was 14. I'll be 67 this year. So it's time to get a little bit back. So anyway, the point is, right now in my career, after 40 years in the mortgage space, I'm moving a lot of my efforts into the senior market because that's who I am, and that's where my friends are, and that's where I want to be. So um, I'm talking to a lot of people about reverse mortgages, the benefits, the pros and cons, why they work, why sometimes they don't work, et cetera, et cetera. So about 6 months, well, longer than that, probably almost a year now, I decided I was going to write a book about it. And I've studied a lot about the subject, and I've read a lot of books on the subject. I've listened to a lot of people speak on it. And my book is not going to be a technical book. It's going to be more of a Q&A. It's 70 questions that I think are important to kind of know about if you're entertaining the idea of a reverse mortgage, if it may be appropriate for you and your family, or you and your retirement situation, et cetera, et cetera. So I'm taking some of the questions out of the book, and I want to talk about those today. Some of them, I should say, 9 or 10 of them, however we can get through today. And but I want to kind of start at the beginning, because what is reverse mortgage? Okay, reverse mortgage is very simple. It's simply a mortgage. There's nothing special about it. It's not a big mystery. It's simply a mortgage designed for seniors. In Texas, that means if you're over 62, or if you're married, both parties have to be 62. In most states, I think all states except Texas, the spouse could be under 62, but that's not the way it is here in Texas. So again, both parties have to be over 62. And but it basically extends a line of credit to a senior who has equity in their properties, which most people do, most seniors do. They say that 80% of people over 65 own their home. They may not own it outright, but about half of those own properties outright. So there's a lot of equity built up in the country. Matter of fact, 10 to 12 trillion dollars that seniors control, if you will, in home equity around the country, residential home equity. And so a reverse mortgage is an opportunity, if it's appropriate, for a senior to access a portion of that equity to supplement their retirement plan, or to do anything they want with the money, with the option of paying it back. Some people think if you have a reverse mortgage, you can't pay back, and that's simply not true. And there's a growing line of credit that goes along with that you could access as you get older. If you need it for home health care or other reasons, you may have access to money that you may not have saved up. So let's talk about some of my questions. How does a reverse mortgage make possible for someone who wants to avoid moving into a retirement facility down the road? Now, at 67, that's not on the top of my mind personally, but if you're 77 or 87, it may be. So if you are over 62, or if you have parents or family over 62, you may want to pay attention a little bit to some of these conversations we're having. And I'm going to have a lot of guests on in the future around this conversation, financial planners and insurance brokers and people who manage money, that we're going to talk about how this may fit in. But there's a term out there that you may have heard called aging in place. And a lot of people, a lot of seniors, they don't want to go into a nursing, even into what they call assisted living or independent living. Now, some people do. I had a friend of mine's mother. She was living by herself, and she didn't want to do a reverse mortgage. She wanted to sell her home and move into independent living because she had more of a social world there. She could play her bridge, and she could make friends there and do other activities. So there's reasons people want to live in what we would call retirement homes, or assisted living, or independent living primarily. And there's a lot of options for that in Central Texas. I think there's 100 plus available. But for people who don't want to do that, they've been in their home for 30 years, and maybe they're still married, or maybe they're widows or widower. They want to stay in their home. They love their home, and they don't want to go anywhere else. But they don't have the resources financially to sustain a lifestyle that works for them. They may have some pension money and some Social Security income and some assets, could be IRAs or whatnot, but that they have a lot of home equity. And we may come into play and into conversation where they say, well, yeah, I'd like another $1,000 a month or $1,500 a month, and they can draw against that line of credit through this reverse mortgage to supplement their lifestyle. And a lot of people choose to do that. So I'm working with a lady now who's 79, and she owns a home in Round Rock, and it's worth about $400,000. She does have a small mortgage, around 70 grand. And then she does have a second lien, a home improvement loan she had taken out years ago to she'd been there a long time. So she owes about $90,000, and she's in a position financially where that's not working for her because she's not working. She was working up until a couple of years ago when she was 76, but not anymore. So she doesn't have that stream of income. She doesn't have a lot of family support per se, kids that could help her out. So we're going to show her, illustrate to her how we can take care of those mortgage payments for her, which are about $1,000 a month. And she will have to still be responsible for her taxes and insurance, of course, and the maintenance of the maintaining the home, but she can alleviate that payment. And she has access to additional funds because we can get her a loan to about $180,000 through a line of credit. Once we pay off that $90,000 in mortgages, she'll have about $90,000 available that she could access, which is going to change her life. At least that's what she told me. She's going to change her life. So a reverse mortgage makes it possible for people who have equity. These loans are, if you don't have a lot of equity, it's not going to work for you. If you're still carrying a mortgage, and they say about 40% of seniors go into their retirement years, which is, I guess, officially 65 years old, with a mortgage. And that's up from 20% in 1990. So more people are carrying more debt than they used to in general, but certainly the senior market. And they're living a lot longer. I don't have the stats in front of me, but I think the average age for a male is probably around 85 now, maybe a little bit older, and a female maybe 88. So people are living a lot longer, and things are getting more expensive. And so home equity may be a good solution for a lot of people. And so this is another question I propose, because this happened to me. It's happened actually a couple times in the last year. And the question is in the book that I wrote: what happens when a couple in Texas over 62 years old, after 30 years or so of marriage, decide to get divorced? And a very interesting stat that I may have shared this before, but it kind of blows my mind, that divorce, what they call the silver divorce, gray hairs, including me, not divorce, but are getting the rate of divorce in seniors is 4 times what it was 40 years ago, 4 times higher. And it's the fastest growing segment of divorce in the country, even amongst 20-year-olds or 30 or 40-year-olds. It's the fastest segment, not the number of divorces per se, but the fastest segment of people getting divorced. And the baby boomers are aging out. I mean, every day, 10 or 12,000 people are turning 65. So what happens is, a lot of times, in this case, a couple of situations, people had homes paid for, and they're getting divorced. One wants to stay in the home. So we're able to access the equity to pay off the departing spouse, in this case, husband. Both of them, husbands were leaving. The wife wanted to stay. Now they could sell the house and divide the proceeds, or if possible, in some cases, if both parties are still working, they may qualify for a HELOC loan, a equity loan, or a cash out refinance. Those are 2 options that may work. But if they're retired on limited income, a reverse mortgage may be the best solution because they don't have to pay it back. It's optional to pay the money back. So in cases where there's equity positions, one party wants their money, half the equity, of course. Again, it could be deemed by the judge you have to sell the house, but a lot of times they'll say, hey, you guys work it out. However you work it out. And they usually give you about a year to work it out after divorce. In other words, to work it out means to pay off the other party. And typically they'll file a lien on the property, what they call an OLT lien, through a divorce proceeding. And you can either refinance it possibly with a HELOC loan or a cash out Texas refinance, or a reverse. So it's just an option. I'm very clear with people that a reverse mortgage is not for everybody. And we'll talk about that some too. But with a growing market that we're seeing around the country, certainly, but obviously in Texas as well, the senior market is growing. This may be an option for somebody that you know. And here's another question, mainly for the kids. And we're talking about kids. We're not talking about teenagers or 20-year-olds. These are grown adults, 40 and 50-year-olds whose parents are passing away, and then they're, in their future, then maybe they're in their 80s at this point. So, but we have to counsel a lot of the what I call them kids. They're grown-ups, but they're still the children. They're the heirs of the estates, and they're concerned because, hey, Mark, you're you're going to do a loan for my parents, and my inheritance is going to go away, and that's probably true. A portion of their inheritance will be interest on these loans, okay, and equity will be taken up over time. But again, appreciation could take care of that. So the spread, if you will, should be the same. But what choices do they have? They're concerned. A lot of people are concerned, which is a fallacy. It's a myth that when you do a reverse mortgage, that the bank or the government will take over your property, and that's simply not true. The title stays in the person's name, okay, and they can do whatever they want with their home. They can they could refinance the property. I'm talking about the heirs themselves. If somebody inherits a property with a reverse mortgage, they have 1 year to settle that. The companies, the servicing companies, give you 1 year to figure it out what you're going to do. So in that case, they could buy the property, and when I say purchase the property is upside down. If the loan is more than the property's worth, then by contract, by insurance, if you will, they're insured that they can purchase the property if they want to keep it. They say only 1% to 2% of the heirs really want to keep properties they inherit from their parents, but assuming they did, they could purchase that property for 95% of the market value. So let's say that in 20 years, the reverse mortgage has gone to $1 million, or let's say $1.1 million, okay? And the property is worth $1 million. So obviously they owe more than the house is worth on the market, okay? So they couldn't really sell it because then they would be upside down. Now they could buy it for $950,000. They could buy it for 95% of the appraised value of the property. And let's assume that's $1 million. So in the 150, the difference between what they purchased it for and what they owe on the reverse mortgage is forgiven by the government. It's insured. They will never be liable for that debt. So that may be an option for some. Or if they wanted to, they could take it over. They could take title of the property and refinance it. Of course, in that case, it wouldn't work. But let's say the property's worth $1 million, and the reverse mortgage, they have $700,000 balance. Well, they could inherit the property. They could sell it and take the $300,000 profit, or they want to keep it, and they could take title and refinance out of the reverse mortgage into a more traditional mortgage and keep making payments and live there if they chose to. That's what a buddy of mine in Houston did. He's now since sold that property, but Dana lived in a home in Houston down in Meyerland for a long time. His mother aged out; she passed away, and they had a reverse mortgage, and he bought the property. Okay, he took the loan back, he refinanced it, he lived there for several years. He's now moved to Tennessee. So there's a lot of options for heirs as well, but rest assured, you'll never lose title to the property. They're not going to take your home. Nobody takes the house. You own the owner owns it until they pass or they move out. Now, if they move out for at least 12 months, the loan is basically called due as well. So that's another consideration. A friend of mine's father, he was about 80. He had a reverse mortgage for 15 years, and he lived in the home with his wife. His wife passed away. And that rascal went off and got married, about a few years later when he was 83. So anyway, he moved out of Austin, but he still owned the home because he had some family living there. Well, he didn't live there, and they found out, and they called the note due. So that was a problem. So you want to make sure if you're going to leave the property, in his case, he got married and moved off, or maybe you're going to buy another property you want to live in and you still want to keep that house. You can't do that because you have to, by contract, by agreement, by application, you have to agree that you're going to live in that property, and that's what they're going to come find out. So another question I have in my book, are the closing costs too high for the benefit received? Now, it's a very good question because traditionally, reverse mortgages are more expensive to close than a traditional loan. I've done thousands of traditional type loans over the years, And there's always third-party costs involved. There's origination fees, possibly. There's lender costs. There's appraisers. There's title people. There's attorneys. There's surveyors. There's all sorts of people who get paid along the way on a traditional purchase money or refinance loan or construction loan. Okay, if you're going to buy property to live in or invest in, and I wouldn't say their limit. There could be thousands of dollars. Now, a reverse mortgage has an added fee to it. It's called mortgage insurance. The government will, because these loans are insured for two reasons, and we'll talk about one of them we just talked about, that if a property is upside down, you do not have to pay back the difference if you lose money in the property. Number one, they insure it. You just do a deed in lieu of foreclosure. They don't foreclose on you. You simply give the deed back. You sign it back over to the government. Then they do what they want. But what was my point around that? I lost my train of thought. Oh, the closing costs. So the FHA, which is the Department of HUD, has a fee, an insurance cost of 2%. And the 2% is the lesser of the appraised value of the property, or the loan limits currently deemed by the government as the loan limits in FHA, which are around $1.2 million right now. So if your property is worth $2 million, they will not access the line of credit based on the $2 million. The most they will access it is based on a percentage of the $1.2 million. Is there some change, 1.25 or something like that? And it's percent based on your age primarily and how much equity that you have. Okay, that's a different formula for a different day. But we're simply talking about the cost. Now, if your property is worth $500,000, this could be based on the 500, the lesser of the two, between the 1.2 or the appraised value. So her name is Beth. Yeah, Betty. She goes by Betty, actually. Betty's property is worth about $400,000. So we charge up front 2% of that, or $8,000, as a closing fee to the government. It goes directly to the government. Then there's origination fees and some other closing costs. So her total closing costs may run $17,000 or $18,000. And you say, well, God, Mark, that's a lot of money. It is a lot of money. But it's also relative to what? There's no other loan product out there. So in her case, it's going to work for her because she plans on living there. She's in good health. Her mind's sharp. She's not going anywhere. She doesn't feel she's going anywhere. So let's say she lives there another 10 years. Okay, 10 years. Basically rent free. In other words, she won't make a mortgage payment for 10 years, and that's going to save her tens of thousands of dollars. Now, obviously the interest will accrue over time. So it's not a gift. It's not free, but the closing costs are relative to what the benefit is. It's not the benefit for everybody. If she's were to be wanting to move in a couple of years let's say to move into a retirement facility, or just to move for whatever reason, then it would be a ripoff. I wouldn't make that loan to her because that would be unethical, because it'd be a waste of her money. I would recommend that she do something different. Most likely, in her case, probably sell the property because she really can't afford it. Matter of fact, we're doing what they call a Lisa with her because she's behind on her taxes. She's not really behind on her taxes, but through her through her qualifications, it's a long story, but we're able to arrange a line of credit, not only a line of credit, but a set aside fund to pay her tax and insurance over the next several years, as long as she lives there, coming out of the reverse mortgage. So she'll be actually debt free as far as mortgage payments or rent, or not rent, but insurance and taxes. So you always have to analyze whether are the closing costs too much, or do you see value enough to go ahead and pay her, because they are expensive. There's no question about it. Another question I have in here is, can I use a reverse mortgage to buy a home? Most people don't know that. Most real estate agents don't know that. As a matter of fact, I got a loan, what they call CE course approved through the Real Estate Commission. I teach CE to realtors. And I was fascinated by how many agents that I've talked to don't even know that a senior can buy a property using a reverse mortgage. Most of them, I'd say 4 out of 5, don't even know that. So I'm teaching a 2-hour CE on how to talk with seniors. It may be an option for some, as opposed to paying cash for a property. They can use some of those proceeds to buy the property and hold some of the money back. So you can certainly buy properties using reverse mortgages. In Texas in general, and maybe a lot of other states, Florida certainly, Tennessee I hear is the same way. A lot of seniors are flocking to these states for different reasons, mainly to get out of the cold if you live in Detroit. So you want to come to a little warmer climate. But a lot of come in and pay cash for a property, which is fine. That's a one solution. But we can show you how to structure a reverse mortgage that may even be a better solution. So again, if you're over 62 and you want to buy real estate and live there long term, again, in one of the communities like Sun City, possibly, or some of the over 55 communities like Kissing Tree down in San Marcos, it could be a great solution for you. We can at least talk about it and run the numbers. It doesn't cost anything to look. Also, another question that comes up a lot that we're starting to talk to a lot of financial planners. Financial planners are starting to be more and more open to this conversation about reverse mortgages for their clients. And here's the reason. Most of them get paid by managing assets under management. So the more they manage, the more income the advisor makes. That's usually how it's done. Not always, but usually. And so financial planners who service lots of clients with lots of money, they say, well, the more I manage, my income is going to be intact as well, or growing. So how does a reverse mortgage preserve retirement funds? Let's say a large IRA as an example. Well, there's mainly a couple of reasons. Mainly that if you access equity from your home, your homestead, and let's say you're taking $2,000 or $3,000 a month out of that on a monthly basis, kind of like an annuity. You don't have to set it up like that, but let's assume that's what you did. That money is tax-free. You don't pay taxes on it because it's proceeds from a loan, from a mortgage loan. So you do not pay any income tax on it. You don't report it like you would a distribution from an IRA. So if you're taking $2,000 or $3,000 from an IRA every month, then you're going to report that and you pay taxes on it. So again, a reverse mortgage will save you a lot of money come April 15th that you won't be paying a third of that back to the government as far as taxes. In addition, obviously markets ebb and flow. So if the stock market were to go down and your asset base goes down from $1.5 million to $1.4 million, as an example, you probably don't want to draw against that because you're in a down market. You want to keep that money working for you, and in time, most likely it's going to go back up. So reverse mortgage just supplement your income as opposed to taking money from your IRA, take money from your equity. You don't pay taxes on it, and give your assets, your retirement funds, time to regain their value, which normally they will. I mean, we've seen a lot of corrections over the years. 2008 was a big one. We had another one a few years ago where the market will pull back for a while, different reasons, economic reasons. And typically they've always gone back. They've always gone back up. So again, a reverse mortgage may be a solution temporarily to while the market's approved to keep your money flowing, but keep your asset base working for you. And that speaks to what options would I have to access equity if I were to get a reverse mortgage. And there's really three ways. One is to take a lump sum. You could take, whatever you are approved for. You could borrow that line of credit. You could take all the money out if you wanted to. Now, in the first year, there are limitations. You can't access 100% of it, but in the next year, in the second year, you could take the whole thing. You could write yourself a check for $100,000 or $200,000 or whatever it is. That's one way of doing it. The other way is you have a fixed amount for a period of time. Let's say, Mark, I'm planning on being here for 10 years, so I want to access a check for 10 years. And they'll do the calculation based on how much you're available to you, and they'll send you a check like an annuity every month for 10 years, and that's guaranteed. They can't not do that, okay? And the third way is also it's called tenure. It's not 10 years, it's tenure, which means that they'll do a estimate of how long you're going to live. And again, like an annuity, they'll give you a check as long as you live in that property, as long as you live, period. So again, that'll be a lesser amount because we don't know. And whatever's left over, of course, can be willed to your children or heirs or whatever. Or you could sell the property down the road if you chose to. You don't have to keep these loans. There's nothing that says you have to stay in the property. I mean, you have to live in the property. That doesn't mean you have to stay you could sell the property. That's what my point is. And so finally, what kind of properties qualify for reverse mortgage? And this is a great question. Typically, it's going to be very similar to a regular mortgage because FHA, you can do what they call 1 to 4 family, a single family, duplex, triplex, fourplex. The other benefit, if you wanted to, you could buy a fourplex, and there's not that many available, but I've done some loans on fourplexes over the years. They're certainly there. As long as you live in one unit, you can buy uh, fourplex with a reverse mortgage, if you're over 62, of course, and you qualify, and not make a mortgage payment on that property, and at the same time receive the rents in from the other 3 units. So not only you're not making a mortgage payment, you receive income. So it could be used as an investment vehicle too. Now that's an unusual situation. Most of the time, 99% probably is going to be with single family homes that people own. Now it can also be condos. I'm working with a gentleman now who's got a condo in South Austin, and we have to get the complex approved because the complex is uh, not uh, norm. It's not approved as a FHA as we speak. So we have to work with the HOA and things like that to get the complex approved. We can't do a loan in a condominium unless it's FHA approved. And the other is a mobile home. You can do a reverse mortgage on a mobile home as long as it meets requirements by FHA. Again, I just did a purchase loan on a mobile home in Belton County, and we had to make sure through inspections and appraisals and that sort of thing that the property is approved with FHA, which it was, and he closed, put down 3.5% on a purchase. Now he could do the same thing if he's older. He could do a reverse mortgage possibly. So those are just some of the questions out of the book that I thought I'd give you guys. If you have any questions, call me at 512-789-6967. I'm right here in Austin, Texas. I live in Lakeway and would love to talk with you if you're in Central Texas about possibly looking at a reverse mortgage for either you or a family member.